Good evening, everyone. Welcome to the channel. Today I am going to talk about Wharf Holdings interim report. Do note that this is not a financial advice or a buy or sell call. All content are AI generated and is not associated with anyone. The Wharf Holdings Limited is a diversified company with a long history in Hong Kong. Its businesses can be summarized into several key areas. 1. Investment properties. Wharf owns and manages properties in Hong Kong, including the exclusive Peak portfolio, and mainland China, led by International Finance Squares (IFS) developments. 2. Development properties. The company has a significant land bank in Hong Kong, 2.8 million SQ/ft, and mainland China, 1.2 million SQ/m, with a focus on commercial properties. 3. Hotels. Wharf operates 16 hotels across Hong Kong, mainland China, and the Philippines under 3 brands: Niccolo, Marco Polo, and Mako. 4. Logistics infrastructure. The company owns and operates modern terminals, which manages container terminals in Hong Kong and Shenzhen, and is a partner in Hong Kong Air Cargo Terminals. 5. Community services. Wharf's Business and Community (BIC) initiative focuses on education and community development through programs like Project We Can, as well as promoting sustainable practices and reducing carbon emissions. The recent surge in Wharf Holdings stock price can be attributed to several key factors. Firstly, the company's strong financial performance has been a major contributor, with a significant turnaround in its results over the past year. The company reported a shareholder profit of HKD 535 million for the 6 months ending June 30, 2025, surpassing analysts' expectations due to lower than anticipated interest and tax expenses. Additionally, Wharf Holdings has demonstrated revenue growth of 12% and a substantial swing in net income growth, despite net income remaining technically negative. The positive market outlook for Hong Kong property, driven by ongoing urbanization, a slowed supply pipeline, and prospective policy initiatives, is also expected to bolster demand and pricing power for premium residential and commercial assets. Furthermore, analyst upgrades have played a significant role in the stock price increase, with DBS upgrading its rating for Wharf Holdings to buy following better-than-expected interim results. The upgrade was influenced by the stock price rising to its 10-year average discount to net asset value and the potential for positive market responses to upcoming residential projects. Overall, these factors have combined to drive a 23.23% increase in Wharf Holdings stock price over the past year, with some reports indicating a total return of 26%. The primary drivers of revenue growth or decline can be summarized as follows. Revenue growth drivers. 1. Development properties revenue growth, increasing by 56% due to Hong Kong properties. 2. Attributable contracted sales increase in mainland China investment and development properties. 3. Interest expenses and taxation reduction contributing to revenue growth. 4. Long-term investments increasing by 15%, contributing to revenue growth. Revenue decline drivers. 1. Operating profit decrease in Hong Kong properties, resulting in a decline of $148 million. 2. Overall segment revenue decline in mainland China investment properties by 4%. 3. Revenue decline in development properties in mainland China by -23.4%. 4. Significant revenue decline in the hotel segment by -91.7%. These drivers highlight the key factors influencing revenue growth and decline, with a focus on specific segments and geographic locations. The company's financial performance indicates a strong ability to generate cash from its core operations. According to the financial summary, the company has achieved a significant milestone by generating positive operating cash flow. Specifically, page 11 highlights that operating activities have resulted in a net cash inflow of HKD billion. This is a clear indication that the company's business model is efficient and profitable, allowing it to generate substantial cash from its daily operations. The company's financial performance was mixed across various segments and regions. On the positive side, the Hong Kong residential market and HONG/KONG properties segment showed significant growth, with a 56% increase in development properties revenue. The logistics and terminals segments also performed well, with notable increases in throughput at Daqing Bay Terminals, Shenzhen, and Shekou Container Terminals. However, some regions and segments struggled. The mainland China property market declined, leading to a 4% drop in revenue and 5% decline in operating profit for the mainland China investment properties segment. Additionally, modern terminals, Hong Kong, hotels, and Hong Kong's investment and development properties all experience declines or mixed results. The company's financial summary reveals that it has a history of paying dividends to its shareholders. This indicates a commitment to returning value to investors through regular distributions. In contrast, the company does not appear to have engaged in share buybacks, suggesting that it is prioritizing other uses for its capital. Concerns about inventory buildup and supply chain disruption. There are growing concerns about inventory buildup and supply chain disruption in the industry. Specifically, there is a problem with slow-moving office inventory that is difficult to liquidate on the mainland. Additionally, U.S. tariffs have disrupted demand and supply chains, while ongoing trade negotiations between China and the U.S. have created uncertainty. Furthermore, major shipping alliances are restructuring their services, leading to a decline in cargo flow at key terminals such as modern terminals. These disruptions pose significant challenges for businesses operating in this sector, highlighting the need for careful management of inventory levels and supply chain resilience. That concludes the financial summary for Wharf Holdings. Feel free to comment below, and I will be happy to answer them when possible.